welcome to another exciting edition of the ES Practical Lawyer free webinar series. My name is GetEquity and I'm the moderator for today's webinar. At ES Training Limited, our mission is to expand the frontiers of continuous learning with courses and training across various areas of practices. We have tagged this webinar series the Launch Hour webinar series and it's slated to hold at 1 p.m. during lunch break every Tuesday and Thursday. After every section, we'll provide the resources in easy accessible format on a go for everyone who is interested. And today's topic is debt in distress. How can capital manager react to emerging challenges? And some of the things that will be discussed is the landscape of private equity, the outlook for restructuring and insolvency of private debt, refinancing capital market strategies. If you have any question while the webinar is going on, please do type in the Q&A or raise your hand, and in due time it will be answered. With great pleasure, it's my pleasure to introduce our speakers for today. We have Michelle Chikeze, who is a partner at GLIs. Thank you so much, Michelle, for joining us today. And we have Ogochukwu Odun, who is a head capital market at Emerging African Group. Thank you, sir, for joining us today. So I'll hand over to Mr. Ogochukwu for his presentation.
Thank you very much. Can I share my screen?
Yes, you can.
Okay, thank you very much. Okay, thank you very much, everyone. And thank you for those who have joined now. And I believe some people will still join along the line. My name is Ogochukwu and I'll be speaking, or my topic is going to cover certain specific areas. And I've highlighted some of the areas here, which is the overview of private equity landscape, the current trends in private debts. Finally, we're going to be looking at executing an effective direct lending strategy in a competitive market. So I'm sure most of us must have heard or seen companies in Nigeria that are growing rapidly in terms of traction, in terms of valuation size, in terms of scalability. We've seen the likes of Kuda. They have outdoor ads everywhere. We've seen the likes of Cheaper. We can see their commercials on TV, Google Ads, YouTube, different platforms. In fact, they have billboards. We have seen Fair Money. Their outdoor billboards are everywhere. We've seen Jumia as well. So these are companies that have taken advantage of the current trends in the private equity space. So I'm looking at an overview of private equity, and I must say that if you want to, if you're looking at the topic debt and distress, one of the things that will come to your mind is how equity or how the private equity market has sort of disrupted the typical debt that we see or that we have always been used to in our day-to-day activities. And we'll see that back then, companies who wanted to scale, go to the bank, they will submit documents, they will want to do this, want to expand our operations, they will submit loads of documents, the bank will go to its credit committee, they will do a lot of review, and if you don't have strong relationships in the bank, you cannot access big funds. So let's say you wanted to expand your business, you are into the business of production and you needed 1 billion naira to expand your business, you go to bank and they will process. And if you don't have strong relationships, you might end up not getting, the funding. That used to be the trend so many years ago. And, we've seen cases that have been in the courts where they are trying to recover possession, or they're trying to recover debt or recover possession of an asset that the debt was used to finance. We've seen all those trends happen in the past. But right now, when we say debts in distress, we're looking at how that debt market is being disrupted by the major play of private equity funds in Africa. So, private equity is an alternative investment, class. You see that investors invest directly or privately in companies at different stages. Some invest at early stage, some invest at revenue generating stage. Some even invest when the company is, doing extremely well in terms of valuation, and they exit after some time. So we know what a private equity firm is. It's a company set up, composed of investors. Some have general partners, limited partners, investors, and typically composed of the general partners are the ones who provide the investment management or fund management, expertise to the fund. In most occasions, the limited partners bring in the funds, and the general partners also bring in the funds, but they also control the aspect of investments. Now, we've seen that private equity firms outside and even in Nigeria, they started focusing on certain areas. So when I say certain areas, some are sector agnostic, but we've seen that a lot of them focus on technology, and which is in line with driving ESG or sustainable development goals in Africa. Some other funds focus on women, ensuring that they empower women to scale their businesses. So we see that usually, like I said, if it was debt, they will just go arrange documents, and if you're lucky, you can get 1 million, you can get 2 million. I remember an SME, and in fact, a small business tried to get funding, and they went to the bank, and when they got to the bank said, "Oh, you want to take 1 million naira loan? Okay, let me see what is your business doing? Oh, my business can pay back the loan. Okay, we know your business can pay back the loan, but go and get a guarantor that can give you 1 million naira, that ends up to 1 million naira to be that guarantor." And it was funny because where will you find that kind of person? And nobody these days is willing to give you that kind of guarantee. So we've heard all those stories, but with the emergence of private equity now, you see that young people who start businesses and are looking to scale can go to a private equity firm, apply for funding, and get a reasonable amount of funding. And how does this work now? Now we see that most companies start from the pre-seed stage. Pre-seed stage, essentially, you're getting funding to basically set the ball rolling, to kick the company off. And once the company kicks off and company has started generating reasonable revenue, they go to the next round. So some start pre-seed stage, some start within 5,000 to 100,000. That was even then. Now I have seen pre-seeds that are up to $1 million. I've seen pre-seeds that are up to 1.3. So depending on how the company operates, what the company is going to utilize the funds for, and what the valuation will be after the pre-seed. So after the pre-seed, we see that most companies now do the seed round. And by the time you're doing the seed round, the company has started generating significant revenue, above 10K monthly. We see some of them above 10K monthly. After the seed round, they do Series A. At the time you're doing Series A, some of the companies that I even know, at that point in time, the price per share is already about $8 per share. And if your share price is $8 per share, and you have 10 million shares already, you know what that comes to in terms of monetary value. And those companies who are even doing the seed, some of them, you see people do the Series A seed at $100 million valuation for the company. And from Series A, they go to Series B, Series C, and D, and so on and so forth. So now this has become a trend. And recently we saw that in Africa, Nigeria had the largest share of the private equity investments in Africa. And like I said, we've seen companies like Kuda, Chipa, Mono, and the rest of them. In my subsequent slide, I'll just show you a few things or few companies that have benefited from this and how this is affecting the debt market itself. So this is just a general structure of how private equity firm work, but this is not relevant for what we want to achieve today. And yet it's just a breakdown. Like I said, Nigeria is the biggest destination for private equity investments in Africa, offshore and onshore. So this is just a sector breakdown of the investment. So you can see that fintech has 62% of the private equity funding was channeled towards the fintech space. We also see e-commerce, agriculture, clean tech, education, logistics, and health tech as well. So, like I said, in terms of current trends for private, I'll come back to this, but I need to take you through. So this is just to show the statistics of the trends in the global equity space. And more recently, we see that it's growing in terms of the equity spend in Nigeria. So now, this is very important for us to look at. Africa PE funds raised a total of 1.3 billion at H1 2021. And we can even see that from H2, in fact, from 2022 already, as at January, there's already statistics on the amount of money that has come into Africa as at January 2022. So there is a huge disruption in the debt space, and the PE firms are actually looking. I saw recently a post on LinkedIn by private equity fund, Platform Capital, saying that their target this year is to invest in about 100 companies. So imagine them investing in 100 startup companies in year 2022. What is the chance for the typical and the usual debt? How does that even affect the debt market in itself? So this is just statistics again, showing the VC deals between 2014 to 2020. And you can see that number of VC deals per year, it keeps growing up to 2020. We can see 319. And you can see the value, the size, 1.1 billion, total value of reported VC deals in Africa as at 2020. Now, this is a list of companies that have benefited from private equity investments, and you can see we have already in Nigeria. As of now, we have Flutterwave, we have Jumia, we have Paystack, quite a number that have become. Quite a number of them that have become. Hold on 1 second. Let me enlarge my screen again. Yes, so quite a number of them that have become unicorns. So I'll go through this. So if you go to ahead, let me even start from here. If you look at Emzor, Paystack, Flutterwave, Rise, Andela, Reliance, HMO, AXA Pension more recently. We check the news, you find out that Reliance HMO recently raised in their Series C $40 million, and they started out from Y Combinator, which is an accelerator, and in their series, raising their seed fund in their Series A, they raised $6 million. In their Series B, they raised $40 million. So in total, they raised about over $46 million. And I have watched this business grow from ground zero. I knew when they started out their first operations, and they've grown. And that is the impact of private equity so far. So if they had a debt funding from a bank, which is usually short term, which is not patient, we don't have patient capital, that are running helter-skelter, trying to see how they can become so profitable and taking their profits to repay their loans. So this is a huge disruption in the market, because we've seen more recently, there are more companies that have tapped into the private equity space. We have the likes of Cowrywise, we have Ulissin, we have Crowdivest, we have Flutterwave. In fact, I was Talent QL. So Talent QL, in fact, I know this company personally, but I've seen them. I knew when they started out, let me put it that way. And Talent QL recently, they've launched Old School. And that Old School in the seed raised about $1.3 million. I understand they're still raising more money in the market. So this has become a recent trend. We need to understand. That if companies want to tap into these opportunities, then if you're either a lawyer or you're a capital markets, you're a capital manager, you must position yourself in a way that you're able to enjoy whatever comes out of this trend, because the way I see this trend is going to last for a while, and people are not are not keen into this space, because I still see a lot of people who are capital managers, fund managers, and they are still looking short term. For me, I've seen that in Nigeria, we like to look short term. So if a startup goes to, I was reading the story of Yes Andela, and how they had gone to angel investors looking for seed funding, and they were not willing to support them. You know, what I understand from that is most Nigerians are just looking at, okay, what do I gain now if I put the money in the business? And one of the persons who was reached out to, you know, made a post on LinkedIn saying that if you had known at the time, you would have invested in the company. So I was trying to check. There's a company that I saw today. Yes, Mono. So Mono is also a fintech company, and they also published, they had raised Duplo. They got into Y Combinator, 2022 batch, and they raised 1.3 million in their pre-seed round. So this, every day I follow digital news on LinkedIn, and every day I see companies in different sectors raising funding, and these PE firms are hungry. So we can see that quick delivery as well, there is 1.7 million in the logistics space. So Talent QL is also recruitment. We also saw recently Seamless HR. Seamless HR raised about $10 million. I think it's their Series A funding as well. So the inflow is a lot. And this is a major disruption for us, because if you are a capital manager, you're managing funds and you're investing in businesses and you're looking short term, you need to be creative on how you can ensure that you tap into this opportunity. And how should capital managers react to this? So if you're a capital manager and you have specific funds that only invest in debt, then you should be looking at setting up some kind of funds that gives you flexibility, investing in equity. We see that the trend in the PE space is that most equity firms are registered abroad, mostly Mauritius, because of flexibility, the existing legislations on private equity funding, and the tax incentives as well. So capital managers should actually look at innovative ways of setting up structures that can benefit them. Now, why I'm saying this is that if there is disruption in a space, just like the fintech guys came and disrupted the traditional banking that we're used to, and everybody is moving very fast and following the fintech guys. If there's disruption in space and the relevant players in that space do not tap into it, that will cause you to be backward when others are forward. That's why I'm trying to use the opportunity to educate you that for some of us who are listening, you can fall into one category or the other. Is either you fall into the startup category, positioning yourself to be part of the private equity funding, or you fall in the lawyer category, positioning yourself to also be a player in this space, or you fall in the capital manager category, meaning that you're creating an opportunity, you're creating some form of, the funny thing, the good thing about at the seed level or the pre-seed level, even as an angel investor, as a HNI, even as you are as a young person and you have 10 million naira, 5 million naira sitting down doing nothing, strategically you can start taking positions in startups that, I see that GetEquity now, GetEquity raised, I think they raised about $1 million or so, or I think about 200K. Yes, they raised about 200K. And now they've created a platform where startups, they can crowdfund equity funding from retail investors and also put it in startups. So it's an opportunity for you to key into this space. And now this is how it's affecting the private sector. We see that most people now are looking for opportunities to grow their funds. And that's why we see people putting money in all sorts of things. Agro this, agro that, agro allied, agro that, see people putting that. And the reason why they're putting their money in things like that is because they are looking for outlets where they put in money and it's going to yield results. Capital managers are looking for outlets, they put in money and they are going to yield results. But think about it this way. The private equity firms who put in investments in companies, within 4 or 5 years, the company has done up to Series A, they are worth $1 billion and they sell their shares. By the time you sell the shares, the money that you think you wanted to make you want to make 60% per 6 months on where you put your money. That money you're making in 3 years' time, you're making times 100 of the amounts that you put in. So we saw that happen in the May 1 share exits, where Equinox acquired shares in May 1 and cash was paid and the shareholders cashed out like money. I've seen that happen even in the Reliance HMO as well. The guys who have cashed out from there. I've also seen the Paystack CEO, the Flutterwave CEO, taking positions now by investing in company. And the Duplo company that fintech company I mentioned now, the CEO of Flutterwave was also an investor in that round. So how is this essentially affecting? So how is this essentially affecting the private markets? So recently we've seen that, or how is this, what is the effect in terms of current trends in the private market? Recently we've seen that the private market also has taken a new dynamic in the sense that we usually used to see the role of SEC in raising funds. As a company, if you needed to raise funds, you have to go through the SEC, go through so much, put in so much documentation together, get your prospectus, file these, get 2 ratings so that you can increase your investor community. The SEC will probably take time to review your application. It might even take you, going in-house to chase them to move your file. You get approval. And if you're a private company, can register an SPV, PLC, raise the funds, issue notes to the private company, buys the notes, that is the trend in the private market. But recently we've seen that with the disruption in the debt space as well, we've seen more private issuances. And how does this happen? Private debts are now being structured by capital managers, by investment bankers, and it's a private deal. So typically, the SEC doesn't regulate private placement or privately managed transactions because they feel like if it's a private deal between an institutional investor and an issuer, there is some level of sophistication in terms of investments. So what does that amount to? We've seen that with these opportunities that have come up, the role of SEC has been minimized. People have looked for creative ways of structuring private transactions, private debts. And those private debts typically are now being sold to other private individuals who have, idle funds for them to invest. Now, the challenge that this brings is that for private deals where there are little or no regulation, see that people go overboard with it. People promise, except it's being structured by a reputable investment bank like ours. You see that people structure private deals, promise ridiculous interest rates. In fact, the funds are diverted because there are no ring fencing structure that allows monies that are coming to only go out based on due process or go out through the trustees who back up those transactions. So we see a lot of things are happening in the market, debt space, and this is really affecting how investors are perceiving private debts. So in terms of current trends, we've seen private investments happen through companies who aggregate funds from people, and we've seen some recent fund aggregators, go into serious issues. Even recently, we saw one. We've seen some who have been unable to meet their debt obligations. So this continues to cause distress in the debt markets. Compared to the private equity market, we've seen some stability. We've seen some growth. This is not to say that there are no bad private equity investments or investments that have gone bad in private equity space. They are, but the trends of the good ones are actually more than the bad ones. And in the private debt space as well, we also have in the private debt space that have actually thrived. We've seen a lot of private bonds recently in the markets. I don't want to mention names, but we've seen lots of private bonds, private notes transactions that have been sold to institutional investors and even some HNIs. And we've seen those transactions start and even close and fully repaid. We've seen private equity markets also skyrocket beyond our imagination. So, I mean, for me, when we say that debt's in distress, for me, I think I look at it from the part of how are all the players in the market reacting to this, not just the capital market managers, how are all the players reacting to it. Some private some capital managers who used to have SEC-regulated funds alone have started setting up some creative tech funds, women funds, agriculture funds. I know Sahel, there's PE firm, Sahel Capital, they do mostly agriculture. So if it's anything around that agriculture value chain, food processing, movement of transportation of food and all that, the finance transaction in that space. So it's been trends, and they've had good transactions. And the good thing is that if you go on their website, you see some of the companies that they funded in recent times, and those things have happened. So, but what are the challenges? As much as we speak about, the private equity space disrupting debt or the effect of private equity in the debt space that has been distressed recently, what are the challenges? There are challenges that that we face or that we see happen in this space. So one of the challenges that we see is the impact of dollars. We know how the trend in dollars continues to affect the Naira. And you see that most of all these capital raises, fundings are in dollars, and the revenues being generated are generated in Naira. So there is obviously a currency mismatch. But we understand that, again, people get creative every day to see how these things can be mitigated. So most of these companies that you see here they are registered in, some of them are registered offshore, some of them are registered in Delaware, some of them are registered in Cayman Islands, some of them are registered in Mauritius. So it makes the injection of foreign currency capital easy. One of the challenges I also see in the private equity space is lack of acceleration programs in Nigeria. So we've seen the likes of 500 startups, Y Combinator. These are accelerators that not just inject capital in the business, but they also ensure that the company is rightly equipped to manage the funds. So I was listening to a conversation from some founders, and they had mentioned how the perception of their remuneration when they got their seed round and their Series A. And I was saying to myself that if a typical Nigerian should invest, and you tell them that this is the remuneration that they will pay you, and you're probably 24 years old and just started a fintech company, they're not going to agree to that. But the foreign investors don't look at it that way, and this is a challenge that we find in this space. Even most startups now are even looking at not involving angel investors in Nigeria into their business, because they see that most people who have funded the business cannot wrap their mind around how much you're paying a full stack developer. You're paying him so much. Why are you paying him so much money? You're a CTO. You're paying him $2,500. Why are you paying him that? Why are you paying him $5,000 per month? It doesn't make any sense. But if you look at the entire private equity landscape, you see that that trend from the foreign investors in terms of how startups are being perceived is brought to Nigeria. So Nigerians have already seen that startups are getting the kind of respect that they deserve. So if there are solicitors that are listening to this, what I would say is this: as a solicitor, you should actually start thinking of how you can play in this space. The debt space, which everybody is chasing after, is let me not say it's crumbling, but is facing so many challenges. And the private equity space is opening up And as a solicitor, you can position yourself by creating simple structures, creating acceleration programs where you can get in the best startups. You can start building relationship with the right kind of foreign investors that can see you as a channel for bringing forward those startups. Because one of the challenges that the PE industry is also facing is ability to find the right startup, because in private equity, there's something called deal origination. So they're always on the lookout for startups that can scale. So as law firms, you can strategically position yourself by starting up some form of startup advisory. There's a lot of legal work involved in starting up your company, because when you're bringing in investors, you want to be sure that you're protected in terms of your voting rights, the number of shares, and the rest of them. So there's a lot of work that the lawyers can do. And if you start early with these startups by positioning them, getting them into one form of accelerator program or the other, you're setting them on the right paths. And at that point in time, when they're about to raise the funding, you become a big part of that funding process. So as capital managers as well, what can you do in terms of taking part in this space? Start thinking of how to create some private funds that can invest in technology, that can invest in agriculture, that can invest in health tech, logistics tech. There's so many of them. Education tech is also coming up. I've seen a lots of proposals recently. I can't remember the name of this education. It's a lady founder, female founder. She raised about $5 million in seed round. She couldn't have gotten that by debt. And that debt will not be patient enough to give her time to turn around that money and scale that business. So you're positioning yourself by creating some form of fund, partnering with fund providers that can fund in this space. So if the current trends we see in the private debt market is also being creative or going out of the regular process of raising funds by either public issuances and the rest of them, they are being creative. But however, the challenge that the private debt continues to face is the fact that the funds is not patient. Apart from the fact that you can raise a 7 years money, that gives you time to turn around the money. It's not as patient as debt and as equity. And as equity, no matter how the unit of shares that you have, you're a part owner in the business. And the more the valuation of the company grows, the more you begin to enjoy that valuation. And when it's time to exit that business, you're exiting. If you enter as one area and the business is growing, you can be exiting as $15 per share. And if you multiply $15 per share times, let's say you have 1 million shares in the company, you know that is a lot of money already. So this is my little 2 cents contribution to this. And I hope this was useful in any way. I try to rush it so that I don't exceed my allotted time. Because my friend and my ex-colleague Michelle will also be taking us on another angle to discuss some of the outcomes from the topic. So thank you very much. I'm open to questions. Maybe after Michelle has taken hers, we can take questions collectively. Thank you very much.
Thank you so much, Mr. Ogochukwu. So over to you, Michelle. Thank you for joining us today.
Thank you very much. Thank you for that introduction. Just detailed discussion around private equity. I will be talking mainly about debt financing and restructuring. And I'll try to make it as short as possible. I don't have any slides to present, but I'll just speak around the topic and touch on some of the issues that impact debt, distressed investment or insolvency, illiquidity situation, things that issuers or companies have to think about when they're in that situation. Okay, so we learned from the pandemic. I mean, we're still, I believe, towards the later end of the pandemic, but we have learned that about 73% of businesses face liquidity challenges during the pandemic, across formal and informal sectors. Just to clear that liquidity challenges differ from insolvency. In liquidity, a company does not have enough current assets to meet its current liability obligations. So those current payments that happen monthly, quarterly, just periodically, less than a year, okay, Insolvency, on the other hand, is when a company doesn't have enough total assets, to satisfy its total liabilities. In those situations, the company will need fresh capital to remain afloat or to prevent loss of value. So this is where you have to discuss around refinancing and restructuring, right? So refinancing really means to replace old debt with new debt, or other financing that has in some way more favorable terms, to both the company and the creditors involved, right? For instance, in a low interest rate environment, debtors want to refinance. Essentially, even if they don't have any liquidity or insolvency situations, they would want to replace existing debt with cheaper, if you will, lower, cheaper debt, other financing. And just to be clear, equity is not cheap, right? It comes with a lot more return, because of the risk element of equity, right? To risk that equity there, essentially. So you might want to refinance debt where the borrower or the obligor has a call option, so has a right to essentially prepay a debt, right? So some of that is to clear some of those kinds of terms, right? The call options might be available with or without the creditor's consent, but typically with the creditor's consent. And you also want to think about the cost of refinancing. If I'm refinancing, and interest rates are lower and I want to refinance, I have to think about transaction costs. So if I'm saving, for instance, if I'm saving 12 million naira, and I'm also going to spend 12 million naira to refinance, it's probably not a good business decision, but you have to look at the cost of refinancing, the cost of transactions, whether there are any penalty or break costs and all of that. And you have to look at the present value and all of that. So those are some of the things that you need to think about. Is it possible? Can I refinance based on the terms of this agreement, or can I engage the creditors, or the trustees in the case of securities to refinance or to change the, to refinance this debt or whatnot. So new financing, may not necessarily be debt. It might be some private equity firms may, if the terms are right, inject equity capital in the business. The majority or some part of that injection will be used to utilized to pay off existing debt, fund working capital, and other pressing financial requirements of a business. And in that case, typically the private equity fund manager will be sure to manage the business in a way that eliminates inefficiencies and essentially turn the business around so they can make a good return for the capital being invested. And when a company is thinking about refinancing, there are certain issues you might want to look at. You want to look at the interest rate environment, like I alluded to my introduction. You want to look at, for instance, currently now in Nigeria, we have a low interest rate environment currently, because the MPD Monetary Policy Committee, they had a meeting January 25th, I think 24th and 25th, but the decision at that meeting was to retain the MPC rate at 11.5% in order to, the CBN talked about allowing the policy measures to really permeate the economy to probably bring out change, just in case there is any lag in how the policy decisions is affecting the economy. So to retain the interest rate at 11.5% to also help the economy to grow, and also to reduce, essentially to rein in inflation that has been on a constant, period increase. So yes, policy interest rates, we know that it determines level of interest rates. So that's really what feeds into whether it's a low interest rate environment or it's a high interest rate environment. And contrasting that with the US interest rate environment, we understand from the meetings in January as well that the committee, the Open Market Committee in the US has decided to increase interest rates, and this comes with implications for capital, for foreign capital in Nigeria. We expect to see that, you know, some of these investors might decide to leave to invest, you know, to buy lower interest rates. High interest rate with lower risk, right? That's foreign securities, federal securities. I meant to say securities issued by the federal government or by local entities that are cheaper. Not that they are cheaper, but they have interest rates that are high and the risks are low compared to an emerging country like Nigeria. So the expectation is that Nigeria will have fewer forex investments, including into distressed, insolvent, or illiquid companies in Nigeria. But this does not in any way preclude local refinancing or restructuring deals. So when you're thinking about distressed investing, some private equity firms may be interested in investing in distressed debt. That's buying off distressed debt or securities backed by such distressed debt. This investment, being very high risk, require a lot more return than the usual risky investment, right? So some issues that we need to be considered in such an investment decision, would include authorization. So, I mean, the investment committee, the universe of, the destinations that, a PE fund might be allowed to invest in, whether geographically or, sector, any specific sector. Like Okochukwu mentioned, some PE firms are sector agnostic, meaning they can invest in any sector. Some are sector specific. They are set up to invest in a specific sector, sometimes in a specific geographical location or in a specific outcome. So, before a private equity firm can decide to invest in a company that is distressed, it wants to make sure that it has the authorization to do that. And this also, the authorization might also be limited by the private part, the limited partners in such, or the investors in such PE funds. Private equity funds generally obtain funding from institutional investors like pension funds, sovereign wealth funds, DFIs, insurance companies, financial institutions, high net worth individuals. But something to note is that pension funds, for instance, they require that securities in which pension funds are invested are investment grade rated. So whilst most viable firms will definitely have a good credit rating, the pension commission, that's the Nigerian Pension Commission, may not permit any pension fund to be invested in PE funds. If those PE funds, invest in low credit rated companies or securities. So that's on authorization. So such PE firms, would also want to carry out their, look at what the market trends are. Okochukwu talked a lot about the trends. You want to examine what the trends are and, what are the issues to pay attention to. Analyze which industries are susceptible to downturns, look for, markets or specific areas that there are inefficiencies that, that can be turned around. And something very critical for distressed investing is, dealing with stakeholders. There is a distressed company essentially because there are obligations, there are current obligations that the company doesn't have the liquidity to meet or doesn't have the assets at all to meet. So an important conversation will be looking at trade, having discussions, meetings with creditors, with lenders, trade creditors, with shareholders as well. Some of the terms of those discussions or the topic will be around, having creditors, or whether they're trade creditors or lenders, to restructure debt, to grant some sort of rebate or a moratorium, to discuss, whatever right of consent that might need to be exercised or waived, or to determine essentially what should be the terms of those investments or those rebates or moratorium or whatnot. the discussions around that. So creditors may prefer typically upfront payments as consideration for a reduction on the owed amount in full and final settlement of whatever debt is owed. Upfront payments is typical. That's what we see, and it makes sense, on the basis of the time value of the money, right? So, well, I've started a lot about debt, refinancing. We can also discuss restructuring, which brings me to. Sorry, before I get to debt restructuring, I wanted to mention that it's important to conduct due diligence. So even if a company is in a distressed situation, and then you have opportunity for an investor or private equity firm to inject in capital, you want to be as open as possible so that these investors will understand why the company got to where they are in that kind of illiquid or insolvent situation, and what could go wrong in the future, both from a legal, a tax, or operational or financial standpoint. So you want to make sure, the investor will want to be sure about, review completely clearly in detail, why has this company become insolvent or illiquid at this point? What could go wrong in the future if I invest on these terms and all of that? So the due diligence, involved in that, it cannot be overemphasized. And a lot of, but you could mention a patient capital. This such investing in, a distressed company or an illiquid company would not be a quick, kind of investment. So it has to be patient. There has to be a long-term investment horizon. So then going on to debt restructuring, it essentially just means changing the terms of an existing debt, right, to terms more favorable to the debtor, or just generally, terms more favorable to the debtor and is acceptable by the creditor. So the interest rates could be reduced, interest payments could be suspended, payments of interest and principal may be delayed, the tenure of the loan might be created, the repayment might be extended such that the debtor has more time to stand back on its feet. For instance, with the COVID situation, we saw the CBN, a lot of the CBN intervention funds, we saw the CBN reduce interest rate from 9.5% to 5%. And last week, we understood that the CBN still retained it at 5% until next year, I think about March 2023. So this enables, rather than pushing this already distressed company into insolvency or an illiquid company into insolvency, those types of restructuring enables this business to remain a going concern, such that it's able to raise or to generate more funds, generate more returns, revenue. That's the right word. To generate more revenue to be able to pay off outstanding debt. So the debt can be restructured also by conversion of debt into equity or any part of it. That's, I've worked on a number of deals, touching on, restructuring debt by converting a huge portion of that into equity. And we see that a lot with the AMCON investment. AMCON acquires the assets of a failing business or failing bank, typically a failing bank or financial institution, and maybe and then debt, that's the non-performing assets, right? And those debts, right, in many occasions are converted into equity. So that's another way to restructure debt. But of course, discussion with stakeholders cannot be overemphasized. You want to have them on the same table. You want to lay your cards open. You want to make sure that you have good corporate governance practices, good liquidity management, treasury management, in the company or in business, such that you create trust, rather than not a situation where there's mismanagement, misappropriation, and whatnot. that's really work against having an investor try to because it will be clear in that situation, maybe not clear, but it's suspicious that, okay, we know the reason why this company is in this financial constraint that it finds itself in, and you don't want to be part of it as an investor. Finally, I want to speak just very briefly about the scheme of arrangement, sort of scheme of arrangement or compromise that is possible under CAMA provisions and the new CAMA 2020 that allows a company creditors to allows the court essentially to sanction a debt restructuring of the company subject to the approval of the SEC. Thank you. I'm happy to take any questions.
Thank you so much, Michelle. Okay, there's a question for you and Mr. Ogochukwu. It says, please, what's the difference between private equity and hedge funds? And can startups take advantage of hedge funds?
Okay, so I'll take this. I mean, private equity funds, like I explained before, are investor funds set up by private investors and investment managers with expertise to invest in different sectors, as the case may be, or to invest in line with the investment objectives. And there are private funds that usually invest in startups. On the other hand, the hedge funds are typically just pool of funds that are used to trade in, let me just say, risky assets. And it's like the word hedge, it's like you're taking a position, like you're speculating, and they are typically very risky and typically don't invest in startups. So when you're a startup and you're looking for what to take advantage of, it's a private equity fund. And there are so many out there. There are hundreds of them. There are hundreds of them that are giving out money, dollars up to from 500K, giving up to $1 million. Once you can show that your business has some form of, either it's impact driven, it's technological driven, or is in line with the SDG goals. I mean, you'll find investors out there that are either sector specific or are willing to support based on the company meeting certain criteria. But it's basically just PEs, or let me say the VCs as well, the venture capitals who typically deal in smaller sizes than the PEs. Because what we find is that it's also important to mention that the PE firms, most PE firms they have a large ticket size. You see that most PE firms they don't do anything less than $10 million. They do 10 million above. So from the startup side, is usually the VCs that provide the kind of support that the startups needs.
Thank you so much, Mr. Ogochukwu. Michelle, would you like to add to this answer?
Yes, I think that explanation is great. Hedge funds invest in various assets, they speculate, and we don't have many of them. We have many of them in Nigeria. And the SEC experience that we've had, not that there are in some rules, but they haven't been very well developed to regulate such funds. So that's what I would like to add.
Okay, thank you so much. Okay, there's another question. Does hedge restructuring take the place of arrangement or compromise, or is it a subcategory of debt restructuring?
It's just one of the options, right? It's just one of the options that is set out in CAMA, where creditors of a company can agree to a restructuring plan, essentially, under a scheme that is sanctioned by the court and approved by the SEC. So that's just one of the many ways that they can be restructured.
Okay, thank you. There's also another question. At what stage of a startup phase should a company seek private equity, and what should investors look out for? guess that's from Salvatore.
Yes, so like I said, so there are early stage venture capital funds. There are seed stage venture capital funds. There are pre-seed as well. So if you ask me at what stage, now it now depends on what kind of business, the kind of business that you do. If you're doing a business that the technology has been tested, for example, if you come up with a fintech solution, fintech products have been tested in the market, it's like plug and play now. If you come out with a pitch deck on setting up a fintech solution that encourages financial inclusion or what's not amongst even the, let's say, the lower class people, I mean, at that stage where you have not even started building anything, you have not built the platform yet, but you have a pitch deck saying, you do this, you do that, which essentially early stage, you can get funding. And what they're going to be looking at is, one, as the product you're building being tested in the market. Number two, they're going to be looking at the competitive landscape. Who are the people that are doing what you're doing? How did they thrive? How do you intend to overtake that market? What you're doing, is it scalable? So scalability, proven technology are two key areas, and the competitive market are three key areas that they look at if you have not started anything. But you know, sometimes it's always good to, if you're doing a kind of business that you think you can bootstrap with personal funds, funds from friends and family, it's usually advisable to bootstrap the business to a certain extent. And what that does for you is that it helps to show commitment. So when investors see that, oh, look, this person has bootstrapped the business has a few clients, the business is generating revenue already, the business has the potential to go. So you've shown the potential to go. So you have done the business for 6 months and you see that, oh, in my month 1, I made X, or I had X customers. In month 6, even if it's 1 year, and you're able to show traction that, oh, I had 10 users in month 1, in month 12, I had 15 users, or I have 500 users in month 12, they can see traction. So investors are very, so like I said, if you ask me what stage, I would say early stage, go for, start applying to accelerator programs, applying to VC firms. There are a lot of them online. And if you apply to those investors, whilst you are doing that, I advise you to kick off the business. Let the business have some form of, if not revenue generating, at least user acceptance. You know, user acceptance, have your pitch deck ready. They're very, very particular about your pitch deck and the quality of your pitch deck. They're also very particular about the people, because I realize that the VC firms and the PE firms invest in people. So I'll give an instance. One of the former co-founders of Andela started a company known as Eden Life. Eden Life raised, I think in their seed round, they raised about $1.3 million, and they're doing very, very well. I think they've raised their Series A now. Talent QL also was a former founder. It was a former co-founder of I think Tech Point Africa. He started Talent QL. After Talent QL, he also started Alt School Africa, and he was able to raise money easily. So what they look at is the people. So you must build your personality, you must build your profile, you must build your track record. The team members that you're starting the company with, it's always advisable to have a co-founder. And that co-founder was somebody who has some pedigree, either in the space you're playing. Let's say you're trying to build a tech product, the co-founder should be a CTO or a full stack guy, somebody who understands tech very, very well. So they look at the quality of the team, the quality of your pitch deck, the scalability of your business, and also the how proven the technologies that you're using is in the market. So that's my advice.
Thank you so much, Mr. Ogochukwu. Thank you so much, Michelle, for a very insightful presentation. I guess that will be the end of questions today. A very big thank you to our sponsors, Farmview, Advocates Law Practice, GLIs and Co, DOA, and African Law Practice for sponsoring our webinar today. Thank you to our attendees for attending our webinars today. Our next webinar will be on Thursday, and we'll be talking about patent licensing upfront. Thank you to everyone for joining us today. Michelle, thank you so much, and Mr. Ogochukwu, thank you so much for joining us today. If you need the slides, please do send your email address to the chat box. I will still be on the call to get your email address. Thank you so much.
Thank
Thank
you.
you. Have
Bye-bye.
a nice
You
day.
have a nice day. Bye.
Bye.